definition of a trend. The last two important things that he set forth were volume works in conjunction with price, and most people are very aware of the fact that volume tends to increase in the direction of the trend and dry up on the reactions. And then the last thing that he put forth was that the market will, at times in its corrective process, make a line, a sideways line. And he defined what the line was. And that, too, sets forth a basis for a trade plan at a later point. You know, we can look at lines all the time in the market, sideways lines, congestion areas, consolidation areas. And again, this was part of the foundation that people then went on to, with point and figure charting, to quantify the lines and where they projected. The next person that came along after Dow, and all these men actually were in the markets at the same time. They were all trading at the same time. They were all writing at the same time. Most of them died young. Draw your conclusions there about the business. But the next person was a person named Schabacker. And Schabacker wrote 3 stupendous volumes of books. And, of course, he died in his early 30s. And it's a real shame because I think he was a very prolific writer. And one of his books was just republished. But Schabacker actually is the father of the pure science of technical analysis. And by that I mean the objective ability to classify chart patterns. He was the one who gave the names to head and shoulders and triangles and flags. And he had about 10 different names for different types of triangles. And he also documented gap theory. For example, if the market gaps up and it doesn't fill that gap, that in and of itself has powerful forecasting information. Okay, he was the one that used trend lines to define support and resistance levels. And these very basic concepts, I mean, you can make it as a trader if you have a solid understanding of just the simple support and resistance, looking at the swing lows, looking at the swing highs, and seeing how the market trades around those points. So these were some of the things that Schabacker contributed. In his classification of patterns, I will tell you the 2 most important pieces of information that I got out of studying this. And again, it's just from a conceptual standpoint, and it might sound overly simple, but I'm going to show you how it ties in at the end when you're actually trading. The simplest thing that he said was, with chart patterns, he separated them into reversal patterns or continuation patterns. And obviously continuation patterns would be small flags, pennants, triangles. Reversal patterns would be head and shoulders, broadening tops. And as a general rule of thumb, continuation patterns are much shorter than reversal patterns. And the longer a market starts to trade sideways, ultimately, the greater the odds that it will be a reversal pattern. So if you're a trader and you see a large thrust up and the market starts to pull back and consolidate, and it looks like it's a bull flag, in other words, forecasting another leg up, but instead it keeps going sideways and sideways and sideways, odds are then that that bull flag will fail and it'll come out the downside. And actually that same pattern happened yesterday in the S&Ps when we rallied up sharply in the morning. And we proceeded to go sideways, and instead of having another leg up, it had to have a very sharp washout first before it then came back in the afternoon. So if you're a trader, you can be on your guard if the market starts to go sideways for too long. Be on the guard for a potential reversal. So those were 2 of the things that I got out of Schabacker's teachings. The next person who took this one step further was Wyckoff. And Wyckoff put forth that instead of just having chart patterns, here's accumulation, markup, distribution, now we actually have a sequence to the market's behavior. And Wyckoff was the one who gave the words or the definitions to things like a selling climax. And if the market has climatic action, then you'll get an automatic reaction or a rally back up where all the people who got caught in it first want to get out, and the market has to go back down for a retest. So we introduced these concepts of the testing, the action-reaction, but again, put them into a sequence. And the next thing that Wyckoff did was to look at the nuances within the chart patterns. Schabacher was a little bit more mechanical and saying, okay, here's a bull flag, here's a sideways rectangular pattern. But now Wyckoff started going, what can we get to, how can we analyze which way this pattern might come out? Let's look at the market's method for shaking out the longs first before it comes out the upside, right? Let's look at the volume at those points so we can see if that shakeout is for real or not. Let's look at the volume in the market 2 trading days ago on the S&Ps when we traded down below the 1220 level, again down to 1218, and let's look at the volume that was occurring down there. There wasn't any volume. We were making new lows, testing, trying to shake people out, trying to think that we were going to break to the downside with no volume, and the market popped right back in. Okay? Let's classify those types of patterns as springs and upthrusts and give them little names, hooks, so that we can start to have some forecasting value out of those small patterns. So Wyckoff started to get a little bit more in depth in looking at these things. And lastly, he wasn't quite with this group because he came a little bit later, but Elliott. Everybody knows of Elliott wave theory, which it was never originally called Elliott wave theory. But Elliott introduced the concept that waves can be patterns, all right? Instead of just chart formations being patterns, that these waves repeat themselves. And he identified, okay, if you have a wave 3 or a large wave up, it's going to pull back and go up for the retest. So it dovetails hand in glove with Wyckoff's sequence of looking at these climaxes, the rallies, the retests. And the most important principle that Elliott introduced to me was the concept of impulse. And I use that a lot now. Impulse happens in the direction of the trend. I mean, once again, all these concepts sound so simple, but you'll find in your own analysis, in your own trading, that if you can start to think about the markets conceptually, what is it doing? Conceptually, the soybeans had a washout to the downside, of course, right into that first notice day, and they start to pop back up, but they still have to go down for that retest. It will help your trading. And if you're looking at that in terms of the daily picture, you're not going to get too caught up in looking at the 5-minute charts or the 30-minute charts without understanding the overall structure. The market has a play. It has a mission. And ultimately, the best traders I see are able to say, what is that market's play today? Should that market go up and test its highs? Should that market have one more shakeout to the downside? Should the market go sideways to drive everybody nuts up here because the implied premium levels have been way too high, and we can see that in indicators like the VIX index, which has showed a very high implied volatility level, okay? People are either buying puts looking for the downside or buying calls looking for new highs, but we've been in a big old trading range. And so ultimately the market's going to go sideways to drive the most amount of people crazy until that premium level comes down. So you have to think, what is the big play right now? What is the market's mission? And I always find it really interesting when we are in a trading range like we've been. I think that the sentiment tends to swing much more at the levels, at the support levels and the resistance levels. There's an element of tension